For so many of us, the ultimate dream isn't just owning a home, it's owning it free and clear. No more mortgage, no more debt. It feels like the peak of financial success. But what if I told you that reaching that dream could actually be a huge financial mistake? Okay, let's dive into this. I know, it sounds completely backward. We're all taught that debt is the enemy, right? Pay it off as fast as you can. But what if that one decision, that very smart-sounding move, could actually open you up to risks you never saw coming and maybe even hurt your financial security in the long run?
So, while that feeling of being totally mortgage-free is, without a doubt, amazing, the money you use to get there doesn't just vanish. It gets locked away inside the walls of your house. And this can create some real problems. Let's break down some of the biggest hidden risks you really need to consider.
All right, risk number one, and this is probably the most immediate danger, is all about your cash. To pay off a loan that big, a lot of people think about using a huge chunk of their savings. And just like that, you can leave yourself totally exposed financially.
It's a classic trade-off, right? On one hand, you get to ditch that monthly payment, and that is a huge plus. But on the flip side, what happens if a big medical bill comes up or you unexpectedly lose your job? Without that emergency fund, you might be forced to sell your investments when the market is way down, or even worse, rack up high-interest credit card debt just to stay afloat. So what you've really done is traded your financial flexibility for an asset you can't easily spend.
And that lack of flexibility leads us straight into our second risk, which is all about something called opportunity cost. If you have a mortgage with a really low interest rate, say 3 or 4%, every single dollar you use to pay it off is a dollar that could have been out there working much, much harder for you somewhere else.
Think of it like this. Yeah, paying off the mortgage gives you simplicity. It's predictable, and there's real value in that. But investing that same chunk of money could lead to way more growth in the long run. Even conservative options, like certain investment products that offer a fixed rate of return, could potentially earn you more than the interest you're paying on your loan, and that's all thanks to the magic of compounding, which can seriously boost your retirement income down the road. Now, this risk is absolutely critical for anyone who's getting close to retirement or is already there. See, at this stage in your life, the game changes. The number one priority isn't just building wealth anymore. It's about creating a reliable, lifelong paycheck. And let's be honest, your paid-off house isn't going to mail you a check every month.
So while the peace of mind you get is a huge pro, the financial cons can be pretty serious. You're taking a liquid asset, your savings, which could be generating income, and you're converting it into illiquid home equity. This shrinks your flexibility and could make you way more reliant on Social Security than you'd like to be.
Okay, let's switch gears from opportunity cost and just talk about simple math. It feels really good to tackle your biggest loan, right? But it is financially backward to aggressively pay down a low-interest mortgage while you're still carrying high-interest debt, like credit cards or personal loans.
I mean, just think about it. Your mortgage might be at 4%, but your credit card could be screaming at you at 24%. Every extra dollar you put toward that mortgage instead of the credit card is basically costing you 20% in interest. The smartest move, every time, is to wipe out the most expensive debt first. That's how you really free up your cash flow.
Now, we have to talk about where this money for the payoff is coming from, because if you're thinking about pulling it from a tax-deferred retirement account like a 401k or a traditional IRA, you need to hit the brakes. You could be setting yourself up to hand a huge chunk of that money straight to the IRS.
See, that withdrawal isn't just money in your bank account. The government considers it taxable income for that year. This can easily push you into a higher tax bracket. And it gets worse. It can even trigger extra surcharges on your Medicare premiums. On top of that, you lose all the future tax-deferred growth that money would have made. It can be a real triple whammy.
And this brings us to our final risk, which honestly ties all the others together. You could end up with a net worth that looks incredible on paper, but you can't actually access almost any of it. You become what we call house rich, but cash poor.
And this really sums up the whole dilemma. You own your home free and clear, and that feels fantastic. But that equity doesn't pay for your groceries. It doesn't cover a medical emergency, and it won't fund your retirement travels. You can't spend a brick from your fireplace, right? Having all your wealth locked up in one illiquid asset actually makes you financially fragile. So if paying off the mortgage isn't always the best move, what's the alternative? Well, it's about shifting your mindset. You stop thinking about just eliminating debt and start thinking about actively creating income, especially for retirement. One really powerful strategy to consider involves a feature often found in annuities called a guaranteed lifetime withdrawal benefit, or a GLWB. Now, don't let the name intimidate you. It's pretty simple. It basically turns a portion of your savings into your own personal pension, a predictable paycheck that you can't outlive no matter what the market is doing.
I absolutely love this quote from our source material because it just puts everything in perfect perspective. You're going to spend that money one way or another, either paying the mortgage or investing it. The real question is, which option gives you a better return? Locking it away on your walls or using it to create a guaranteed income stream for the rest of your life?
Now, after hearing all that, you're probably thinking, so is paying off my mortgage always a bad idea? And the answer is a big, resounding no. There are absolutely situations where it makes perfect sense. Let's take a look at a few of those.
It's a really smart choice if you still have plenty of cash and savings left over after the payoff. Or if your mortgage has a high interest rate, let's say 6% or higher. For some people, the psychological benefit, that peace of mind and simplicity, outweighs any potential investment return. And that is a perfectly valid choice. And of course, if you're already financially independent with lots of other income streams, paying it off is a great way to simplify your life.
So what's the key takeaway from all of this? It's that there is no one-size-fits-all answer. The right decision for you depends completely on your age, your financial goals, your other debts, and your personal comfort level with risk.
The best way to figure this out is to see a direct side-by-side comparison of your options. This is exactly what a financial professional can help you with. They can show you precisely how paying off your mortgage stacks up against other strategies, like using an annuity to generate retirement income that's tailored for your specific situation.
At The Annuity Expert, we help people compare their insurance and retirement options to find the right fit, and our consultations are always completely free. If you'd like your own personalized comparison to help you make a decision with confidence, just give us a call at 770-755-1565 or visit us online at annuityexpertadvice.com. Whatever you decide, just make sure it's an informed choice. Thanks for joining me for this explainer.